Regulators are reportedly moving towards easing decades-old rules on shares issued by private companies. The Wall Street Journal says today that sweeping review could remake the way American startups raise money. Joining us now to discuss the impact of this is Representative Darrell Issa, chairman of the House Oversight Committee. Thank you so much for joining us. SEC Chairman Mary Shapiro sent you a letter talking about perhaps relaxing these rules. What was your reaction to that?
Well, it's quite favorable. As you know, these rules are arbitrary and clearly they limit capital. The other thing is that we believe that in a modern age with more communication, not less, more transparency, not less, we can have it all. We can have larger amounts of private companies seeking private investment and at the same time do better regulation of public companies by not rushing companies to the public market prematurely.
Mr. Issa, good to see you, sir. Do you worry a little bit, though, that there won't be enough transparency and enough information for these so-called secondary private offerings?
Well, there's an awful lot of ways to get that transparency, and the SEC doesn't have a 0-1 situation. They can develop reporting requirements for private companies that provide additional transparency. You understand, you can be a private company with just a few stockholders and not have audited books, basically not even have the kind of shareholder meetings that you and I would be comfortable with. There's a transition from there to public, and over the years it has become so expensive to become and maintain a public presence that it's really discouraged that as a form of capital formation. So that's where this private, or someone might call semi-private option, needs to be explored. And certainly I want to work with the chairwoman to make sure that we provide protections, but it's an arbitrary protection to say you have to have $100 million in assets to be a QIB. You've got to have X 200,000 and this and that to be in another category. We need to, and it's certainly arbitrary to say 499. You might have a company with 10,000 employees and 10,000 former employees, and they still might be very appropriate to be participants in a private company.
So, Mr. Issa, I really want to know, with these potential relaxed rules, what would it mean for the ordinary investor? Would it shut them out at all?
Well, it might actually do them a tremendous amount of good. It would allow for them to seek, if you will, qualified investors, small groups that could focus on these emerging stocks. And because it's not a question of how many, it's a question of how many stockholders. It's not a question of how many entities are overseeing those stockholders. So you could have 10,000 small stockholders represented by maybe 50 groups that are employing somebody to look at these and other stocks, and you could get the best of all worlds. They could be diversified, they could participate in small and emerging companies, and these companies at the same time could expand how much they have in capital and their growth long before they go public, if ever.
But isn't this yet another place where the small investor is disadvantaged? I mean, wasn't that the controversy when Goldman was doing this with Facebook, that it puts the very small investor at a disadvantage where they can't get in on these great deals and make a lot of money, and once again favors the very wealthy client of a place like Goldman Sachs? How do you respond to that?
Well, clearly today, when you have mechanisms that essentially close it, except to the Goldmans and the Merrill Lynch, that's to the detriment. Remember, a 499 rule by definition says, well, I want 499 of the largest. I don't want to have 4,000 and make it smaller. So anything we do to expand the numbers while having reasonable private investment protections would allow private investors to get into companies who want to continue to grow without if you will, the burden of public offering and some of the other problems that I mentioned in the letter to Chairwoman Shapiro, that quite frankly, we need reform of transparency in public companies too, because to a great extent they find themselves not giving information to comply with the SEC rather than giving more information in order to help the public understand the position of their company.
Mr. Issa, there's a lot of this movement towards staying private but raising capital privately, not going public. Is this a way to get around Sarbanes-Oxley and all those related costs?
Well, you know, Larry, you can go overseas and get around Sarbanes-Oxley, and that's going on more and more and more. Large foreign investors or even small investors overseas working with larger entities are finding great opportunities in the United States because Sarbanes-Oxley has been a sword that cut both ways. It intended to fix some evils, but at the same time, it's made it more expensive to go public and less desirable, at least in the U.S.
All right.